Investing can be intimidating to anyone who hasn't gone through the process before, but are there certain things that especially hold women back from investing? From the Sassy Investor, Michelle Hung dives into the female mindset when it comes to investing, including how women perceive the stock market and if they're waiting too long to start investing. Welcome to the MapleMoney Show, the podcast that helps Canadians improve their personal finances to create lasting financial freedom. Would you like to be a socially responsible investor? If so, our sponsor Wealthsimple can help you build a portfolio that focuses on low carbon, clean tech, human rights, and the environment. Get started with socially responsible investing by visiting maplemoney.com/wealthsimple today. Now let's get to Michelle. Hi, Michelle. Welcome to the MapleMoney Show.
Thanks, Tom. Thanks for having me.
So I was talking to you previously, and what I wanted to bring you on for was so that we can kind of go through some of the investing mistakes women make. Obviously, there's a lot of investing mistakes that everybody makes, but I wanted your opinion on sort of what's unique about a woman when she's looking to get into investing or maybe isn't investing. So can we kind of just go through that? What's sort of your first major investing mistake that you believe women make?
Yeah, for sure. And you briefly mentioned it. It's not investing. They're just they're starting too late, and there are just a number of reasons as to why. And just talking to a lot of women of all ages, and the most common one I get from my older clients, the ones that are like near retirement or they're in retirement, is I wish I had started earlier. Mm-hmm. And then I started talking to all the younger generations, Gen X, Gen Y, and just asking them, like, how come you're not investing? A lot of the, call it excuses or reasons, will be, well, I don't know where to start. I don't know, I don't know how to manage my money. I don't know. They just don't, they're scared. I felt like there weren't enough resources out there for them. And which is why I started the Sassy Investor, because a lot of times they'll ask me, oh, what should I invest in? And then I tell them, are they going to do it? Probably not, because they don't know how to. So that's one of the most common mistakes is that. And what I found was that women were very good at saving money. Okay. And that just goes back to when we're very young. I think we were all like pretty good at saving. Just because, when you first, collect your first coin, or grandpa gives you like a nickel or something, we're good at collecting. We're good at saving naturally. But that with the exception of when debt was introduced to us, credit cards and all that stuff. But I'm not gonna get into that. But for the most part, a lot of women are generally good at saving. But the next step is, how do they put that money to work? And the problem being, well, they're not educated enough. They're scared, because we're talking about people's life resources here, right? It's they're scared. They're hanging on to it. They don't want to lose money because of all these myths out there. Where when I tell them, well, you have to invest in the stock markets, and they're like, oh, but I don't want to lose all my money. I'm like, you're not going to lose all your money. So then there are these myths and stigmas out there that kind of scare them away from doing it. And one of the things I like to equate it to is, well, once you start, you're good. It's like the first time we made a purchase online. The very first time you put your credit card in, it's like we were so scared. It's like, okay, I'm going to put in my credit card number. What's going to happen? It's going to get lost in cyberspace forever. My identity is going to get stolen, and that's it. My life is over. It's kind of like that, right? But once they start doing it, they get used to it. It becomes a habit, and it's good. And nowadays, you can even automate the process now, where it's, you select which ETFs you want to invest in, and every month they'll just automatically do it. Or you automatically have transfer money from your bank account to your brokerage account, and that's a really good habit as well.
Do you recommend robo-advisors as well for this?
Yeah, I recommend just putting your money to work, period. It's better than having it sit in a savings account or a checkings account doing nothing.
Yeah, for sure. I often recommend robo-advisors. Why I brought it up, just for anyone that hasn't started investing. It's sort of the easiest way to just to hop right in. And like you said, once you start, you started. And so if you set a monthly goal or a monthly deposit to that robo advisor, it's done.
Exactly.
Yeah. So what's sort of your next major mistake women make?
So the second one is being too conservative. And I think a lot of that comes from, I guess, again, there's that fear of they don't want to lose money. And when I asked, what women of all ages, like young women, I go, are you a risky person or are you risk averse? And they're like, I'm risk averse. I don't want to lose any of my money. And they're like in their 20s. And then that's where the education part comes from, because I go, and I tell them, well, you're not going to lose all your money. The only way you lose all your money is if you sink it all in one stock and that stock goes to zero. Or if you put money in like a general index fund, broad, like even a mutual fund, and then the markets go down and then you sell it and then that's when you lose money. So again, like the education part. And I tell them, like, I came across this blog once, and it was about this girl who was talking about, she was in her teens, like maybe 18, and she wanted to invest. So she goes to the bank and she tells the teller, okay, I want to invest. And they're like, okay, are you a risky person or not risky? She's like, I'm not risky. I don't want to lose my money. So the teller puts this young lady in a bond fund. And then she complains 10 years later how she made no money. And there it is. I go, well, there you go. Well, first of all, the person at the bank just didn't bother to educate her and let her know that you're not going to make anything. And then I always say this, if you're in your 20s and especially in your teens, you have no business being in bonds. Like, for all the risks involved, you get such mediocre returns. You have to take risk because you're going to, like, over the long run, you're going to earn a better return. Historically, equities have earned higher returns than bonds. So you have to take that risk because a couple of percentage makes a huge difference over the long term, and you're actually selling yourself short if you're thinking, oh, I'm going to be risk averse and I'm not going to put my money to work that hard. I'm going to invest in just bonds, or like have their money staying in GICs. They think just because they're not losing money that they're doing themselves a favor. But a couple of percentage points can actually be like a deal breaker. It can make or break your retirement over the long run.
Yeah, I think with something like bonds, the way I see it is the real risk there is if you're invested mostly, or in this case completely, in bonds, then your real risk is that you're not even going to keep up with inflation. So
exactly.
that sounds worse to me than whether my investments make 10% or 4%.
For sure. And then we're in an environment where rates are just going to go up, and that's going to, kill bond prices, right? So when interest rates go up, bond prices go down. And of course they don't know that either. They just equate bonds with, safe, right? But I'm like, there are a number of risks involved. And it's all about having a balance, right? I'm not saying don't invest in bonds. Like, bonds and equities, they move in opposite directions. So you have a little bit of a safety net if you're invested in a lot of equities and you're like, okay, I don't want too much volatility in my portfolio. So I tell them, okay, put some money into some bond ETFs. So you just have that balance. It kind of reduces your returns a bit, but it reduces the overall volatility in your portfolio.
Yeah, I like that sort of classic couch potato where it's 25% bonds and then 25% Canada, 25% US, and 25% international.
That's right. Yeah.
I think doing that quarter bonds is more than enough until you're actually looking at winding down towards retirement.
Yeah. Exactly. And then you bring up a good point. Investing, like diversifying geographically as well. That's one of the points I talk about a lot. We all have this, bias, this home-based bias where, we're Canadian, everything is so safe, like everything is so safe here, but, we're not immune to any economic downturn. Like our industry, our economy is very, very much different compared to the US, compared to a lot of countries in Asia, in Europe. So you have to diversify out of your country as well. Like we live here, we work here, we get paid in Canadian dollars. Like, it's all of our eggs in one basket. Geographically. So you have to diversify outside of your country as well. But yeah, that's a lot of, it's a misconception a lot of people have. And it's one of those things where I have to educate them as well. Cause they're like, oh, I'm familiar with Canada. Our banks are so safe. Like, the stores, or like they're familiar with the brands here. I'm
Yeah,
like, we're very resource based. It's
exactly.
like very like a lot of oil and gas, a lot of mining and exploration. We're not very heavy in tech, where as the US is. So if you want exposure to some better returns, you gotta invest in the US too, right?
Yeah, I'm here in Alberta, and we've seen what
Yeah,
how oil's doing nowadays. So it's
exactly.
yeah, and that's a big part of the Canadian economy. So if you're right, if you're investing mostly in Canada, you're totally going up and down. Just like you wouldn't want to necessarily invest too much in the company you work for. If you work at a certain
Exactly.
store or something like that, you wouldn't want to invest just in that, because if something happens to that company, now you're losing your job and your
And
investment.
exactly 100%. Yeah.
Yeah.
And then if all that's happening, and then your portfolios, and if a lot of it's in Canadian stocks, well then, like, that's like a triple whammy, right? You're like, oh, everything's doing bad. But then, and that actually happened to me, where I worked for a Canadian brokerage firm. I had equity in my firm, and then our we were very much pegged to the resource industry, because I worked in mining and exploration in investment banking. So all that entire industry went down, and I lost my job. My equity went to like almost nothing. But then I looked at my portfolio, and at that time, like 90% of my portfolio was in US stocks. So then all I could do was smile. I'm like, okay, I'm good. Everything else at home can be really crappy, but I look at my portfolio and I'm happy. And that's
Yeah,
it,
yeah,
right?
for sure. Some of the things we covered here, it sounds like a lot of this can be sort of influenced by media. Like the idea that Canadian banks are safe kind of reminds me of 2008, 2009, when the rest of the world seemed to be falling apart, but Canadian banks did relatively well.
Mm-hmm.
And speaking of 2008, also that idea that you can lose like a lot of money on the stock market.
Mm-hmm.
I'm thinking that maybe media probably is influencing a lot of people. And
Oh,
that's probably not
100%.
helping. Yeah.
Yeah, they like to they glorify everything that's like doing really well. They just magnify everything. And that's how bubbles are formed. And then when things are not doing well, they also magnify that, right? They scare people. They hype up people, and they also scare the living crap out of people as well. So it certainly doesn't help. It's like, okay, what happened to what's going on with Bitcoin? I don't see any headlines out there now, right? But like a year ago, everybody was talking about it. Every other article, every other headline I saw was about Bitcoin, when it was almost like $20,000
Yeah.
US. And now it's tanked, and you get the occasional headliners, but not so much anymore. Now no one's touching it, right?
Everyone's moved on to marijuana stocks now, and it'll be the
Exactly.
same thing
Yeah.
where it's too many of them are probably overvalued. There's all these startups that
Exactly.
probably won't even exist.
Yeah. And then now where are the, and again, I don't see a lot of those headlines anymore, right? So they're like poised for a bit of a correction. There is overvaluation. So yeah, it's just whatever is hot, whatever everyone wants to hear about, whatever is popular, that's what they talk about. But they do just, magnify everything. So I always say, well, if it's already headlining, if everyone's talking about it, stay away from it.
Yeah, it's too
Wait
late.
for wait for it to die down a bit. When no one's talking about it, then maybe get in.
I had someone ask me that I was giving a talk here in Calgary, and someone asked me about investing in Bitcoin right in the height of it, November last year, I think. And I kind of said, like, it's not. Sure, I would have loved to have been in early, but it's too late now. Like I would have loved to have bet on black and roulette, and like
Exactly.
sometimes these things just don't work out.
Hindsight's 2020. So
Exactly. I do like your suggestion too of things like ETFs and not getting into these Bitcoins and marijuana stocks, because it's kind of boring, but boring's good.
boring stocks make the most money.
Yeah.
There is, and because they're so simple. So, for example, I given it like CNR, Canadian National Railway.
Yeah.
Okay, they just go from point A to point B, trucking things around, and that's it. But that company pretty much prints money. Okay, it's a cash cow, and there's nothing wrong with making money. So like I always say, you want to build a core first, and your core should have, just a few ETFs. Some of the like the very popular ones like the S&P 500. If you want to get into Canadian market, it's in the TSX Composite, and just it's a core, right? It's not, there's nothing super sexy about it, but that's what you should have, because the markets have returned on average 8 to 10% per year over its entire history, and that's a flat line average. But you want that at the bare minimum. So when I talk to women and a lot of the money is just sitting in a savings account, I go, at least do the bare minimum. Just invest in a few ETFs. If that's all you want to do, if you don't want to look at anything else, if you have no interest in investing in anything else, just put it in this at the bare minimum. But then there are a lot of women that are like, oh, well, they're asking me about marijuana. They're asking me about just, anything like Bitcoin or cryptocurrency, stuff that's hitting the headlines. You're interested because, well, people are making money, and who doesn't want to make money? So I go, well, start with building a core first, then dabble around these higher risk type of investments. But I say, if you want to earn above average returns, you're going to have to put in a little bit more effort. You have to do your research, because you have to be confident in what you're investing in. You can't just go with what the media is saying. That's how you lose money. That's how a lot of people lose money in these types of products.
So let's go on to the next investing mistake you have.
Mm-hmm. So the last one would be high cost mutual funds. The average mutual fund MER in Canada is around just over 2%, around 2.2%. Mm-hmm. And that's really high. If you invest at $500 a month, and just like a regular, and earned the average return, and you were paying 2% per year on your fund, over a period of 20 years, you would have paid about $44,000 in fees. And that's high, because if the average is average cost of your mutual funds are over 2%, but there are ETFs out there that are like 0.2%, like a fraction of the cost. Imagine the amount of money you're saving. Like, that money could be in your pocket. That could make or break your retirement. If you're falling short, like $100,000-$200,000 when you're 65, it's a big deal.
Yeah, for sure.
And that's one of the things that the banks will always sell you, because traditionally, they've been around for the longest time. They make money. A lot of people make money off mutual funds. But nowadays, there are lots of ETFs, a lot of low-cost funds out there, and they're getting cheaper and cheaper. And it legit is a race to the bottom when it comes to fees, because people are starting to realize, well, there are these index funds that literally, these funds that just copy an index. There's like so little work involved. It's not labor intensive. So are we really paying for active management, portfolio managers to be active? No, right? So these fees are a race to the bottom. So if you're paying over 2%, you should really consider, really get out. And I teach people how to replicate their portfolio based on a mutual fund portfolio that they currently have.
Yeah, I've seen people with these portfolios of mutual funds where, yeah, they're all 2% plus, but they're almost trying to index, really, because they're like, well, I need this mutual fund and that mutual fund, and I'm going to get nice and diversified. But it's by then you pretty much do have the index, but you're paying for, like you said, all these mutual fund managers. And then that's where the fee's going. It's commissions to the person that sold it to you, and to the person that's going to run it for you.
Exactly. But then ultimately, everyone's invested in the same thing, right? If you're a Canadian portfolio manager managing a Canadian fund, you're going to be invested in the banks. You're going to be invested in like the big oil companies. If you're in the US, you're going to be invested in Facebook, Google. Everyone's invested in the same thing. So why are you paying a premium to be invested in the same thing as like an index fund? You know what I mean? Everyone's invested in the same thing if you're going to be diversified. So why pay a premium for it?
And if someone doesn't want to get into ETFs, but having to buy them like stocks, then index funds like a TDE series makes perfect sense, because it's like you're still comfortable with the traditional bank, and it's still really a mutual fund, but like you said, it's based on the index, and probably 0.5% or less. So not much better.
For sure.
This all kind of reminds me too of something my friend Jimmy mentions at Retire Happy, is that the idea that all this investing, women should really be doing it as well, and not just letting their husband do it or something, because everybody has a separate retirement. Like you might be a married couple and think, oh, well, we're going to retire together and everything's going to be so great. But there's a couple of things wrong with that. Normally people don't retire at the same time. And then also one of you is going to die before the other. So you got to treat even from investing all the way into retirement, you really got to treat them as individual things. So you might picture the two of you sitting on a beach, but the things happen. So you could get
or you may not end up together. Like the divorce rate is so high. I thought I was going to be with my now ex. Like we were together for 12 years. I thought we were going to be happily ever after until it wasn't the case, right?
Oh, there you go then.
Exactly. And then we have like individual RSPs, individual TFSAs for a reason. It's for an individual. And again, like anything can happen. You just don't know. It's your partner could get into an accident and may not wake up, or you just have to look after yourself as well. And, it kind of drives me crazy when they're like, oh, when I meet women and they're like, oh, my husband's the CFO. I'm like, you have to be the CFO as well. It's a shared partnership. It's just one of those things, because it is managing your life's resources. And a lot of women, like my older clients, they say, I wish I had started earlier, because they ended up get divorced after being married for like 30, 40 years. And now they're on their own and they don't even know how to make a budget. So,
so everybody, just needs to hop in there and be involved, not just, and it probably works both ways. There's probably women that are doing all the finances too, but everybody should treat that a little bit individual. Sure, you're planning some stuff together, but
exactly.
So can you let everyone know where they can find you?
Yeah, for sure. You can check me out on my website at www.thesassyinvestor.ca. And you can find me on Instagram. My handle is at @theSassyInvestor. And I am also on Twitter and LinkedIn.
Thanks for being on the show.
Great. Thank you so much, Tom. Thanks for having me.
Thanks, Michelle, for your advice on the unique issues women face when investing. You can find the show notes for this episode at MapleMoney.com/Michelle Hung. While this episode was geared towards women, you might know a man or woman that's hesitant about investing. If so, please let them know about this episode so we can get more people started with investing. Normally we only mention our sponsors at the beginning of the episode, but in this case, I really think heading to MapleMoney.com/WealthSimple is the simplest way to get started in a low-cost diversified portfolio. Thanks for listening, and we'll see you next week when Maple Money turns 10 years old.